Hi, I'm Sonia Luna, CEO of Aviva Spectrum. My guest today is Erin Selleck. Welcome, Erin.
Oh, thank you so much for that lovely introduction, Sonia, and it's really a pleasure to be with you today.
I'm super excited about this interview because over the years, both in my professional experience and in discussions with other executives, the role of the board and its responsibility seems to grow, not shrink. And our listeners, I know today, will walk away knowing what steps to take when dealing with changes to those oversight responsibilities. And Erin, since you've had significant experience both as an executive and a board member in the financial services industry, can you share with our audience what are the core elements of enterprise risk management for both management and, let's say, the board?
Yes, Sonia, I'm always happy to share my perspective. You mentioned in my intro that I've been in banking my whole career, and because banking adopted ERM early, I've had a lot of years to think about what makes ERM effective and successful. And I always come back to those characteristics of ERM that are going to help the company achieve its business objectives and ultimately create shareholder value. So there's a lot about ERM that accomplishes that, but there are three things that, for me, kind of rise to the top of the list, three core elements. So let me touch on those. First, really strong ERM programs are going to be truly enterprise-wide. They're going to deal with all the risks in the enterprise. They're going to do that in an integrated way, and they're going to involve everybody. Second, ERM programs are going to be forward-looking. They're going to focus on the future. And third, the best ERM programs are going to be strategic. They're going to link risk and opportunity, and they're going to promote the creation of shareholder value, again, what it's ultimately all about. So let me elaborate on each of those just a little bit. First, enterprise risk obviously is enterprise-wide by definition. It's ideally going to be comprehensive, dealing with all of the risks in the enterprise. It's going to deal with those risks in an integrated way using a portfolio concept, and it's going to involve, everybody, the board, executive management, and employees, at all levels and in all functions, not just the risk management function. So when we talk enterprise-wide, we're really talking about enterprise-wide in every sense of that term. So what does that look like in practice? Well, in banking, for example, the ERM program is typically going to incorporate all of the quantitative risks, so market risk or credit risk. And it's also going to incorporate the qualitative risks like strategic risk and compliance risk, reputation risk. These days, cybersecurity risk would certainly be on a bank's list of risks to consider. And HR risks like succession planning and other similar, HR types of matters. And then, industry disruptors, emerging risks like from the fintech sector would likely be in scope. So all of these risks, and certainly many more, they're going to be managed in an integrated way, not just in individual silos. The portfolio approach allows a bank, in this case, to really see the correlations between risks. And we know that in the financial crisis, for example, the correlation between credit and liquidity risk really had a significant impact, and not all institutions survived the impact of that correlation. So these days, banks are really going to focus a lot on those relationships between risks. And then a strong ERM program, everyone in the enterprise, from the board chair to the CEO and the bank teller and the loan officer, everybody in the enterprise is going to be involved and highly engaged with an important role to play. So obviously this is just a quickie example from banking, but the point is that in good, strong ERM, everybody's going to be involved, and it's going to be a comprehensive program that uses a portfolio approach to risk management.
I really appreciate
the
comment. Yeah, I appreciate the comprehensiveness statement as well as key stakeholders, that it's not just key at the board or upper management, it's all the way down. And then the future piece of it, a lot of people see the ERM as a point in time, right? It's a snapshot. Oh, these are the key risks now, and it's rarely looked at, well, wait a minute, some organizations do have forecasts and they have guidance and other financial metrics, but then that, the qualitative metrics that you were mentioning, strategic risks, M&A risks with competition and how they're leveraging their products and services against yours. Those are other ratings that the board, as well as key members of management and the folks, in the lines of services can all participate in that dialogue. And I don't think it should be just one point in time. It should be future focused.
Yeah, absolutely. And that's the second key component I'd really emphasize. And the way I think ERM programs do that best is with a focus on emerging risks. Obviously we're not operating in static environments. So with a good ERM program that's future focused, you can identify those emerging risks very early on, and that gives you a better chance to deal with them. So, in my experience in banking, for example, a lot of those emerging risks have come from the external environment. Obviously, we've seen a lot of changes in the economic environment over the last 10 years and still changing. The regulatory environment's been changing, and then even the competitive landscape, whether it's a non-bank who's entering the banking, traditional banking space or from other avenues. So, whatever the source of those risks, it's really important, I think, to be sure that you're embracing them within a strong ERM program. And then, of course, ERM at its best is strategic, as I mentioned. It should really help the company balance risk and opportunity, and, again, coming back to shareholder value creation. And it's hard to define, what does strategic ERM look like, but certainly in the best programs, there's going to be a strong link between the strategic planning process and ERM. When new products and services are being considered, ERM will be right there from the very beginning to identify, risks that could potentially derail that strategy. And it's continuous. It's not just, do it at planning time, but you're really embedding that strategic component on a continuous basis, always keeping in mind both risks and opportunities.
Right, exactly. It's not just the risk component, but it is those opportunities that may present themselves. And I wanted to get into another key component here in our dialogue today. During your career as a board member, I'm sure you've seen a lot of regulatory changes, especially in the banking, right? Especially after the financial crisis. Can you tell us more about what are the expectations, and best practices for the board's role in effective governance and oversight of the ERM programs?
Yeah, definitely the board's role. It's an important one, and it is growing, particularly, as you mentioned, in regulated industries. And there's a lot that the board has to do, but maybe let me emphasize a couple of things that I think are really foundational. First, obviously, the board has the role in collaborating with management to set the risk appetite. And by collaborating on risk appetite, the board and management can be sure they're on the same page, which is obviously very important, about how much risk the company is willing to take. And then being aligned, the board can obviously also, discharge its oversight responsibilities more effectively. So being on the same page is important. It's hard to define risk appetite. And, in banking, for example, some of the measures that are often used to kind of get to a risk appetite could include things like rating or regulatory or credit ratings or the amount of loss in a stress scenario or those kinds of things. But whatever your industry, you obviously need to be sure that the board is playing an effective role in that establishing and continuously refining, by the way, the risk appetite. It's not a one and done. The second thing, it's obvious, I think, but the board has a key role to play in oversight of the risk management systems. These systems obviously include identification of risk, measurement, monitoring, and ultimately the control of risk. And the board has to play an active role there. So as a board member, I like to ask a lot of questions about the company's risk management systems, the policies, the processes, the people. So I might ask, what are our risk policies? How have they been implemented? And are they effective? Or how capable is our risk management team? And are their skills appropriate for the risks that we're facing? And are our systems capable of supporting us with data and analytics that we need? So a lot of good questions, those and many, many more. And they don't all have to be asked in the boardroom, by the way. At Broadway, where I serve as audit chair and member of the ERM committee, I obviously want to be very confident in our risk management systems and their effectiveness. So I spend a lot of time outside of the boardroom with management on all of those topics. And then just maybe to mention a couple of others, we set the tone at the top. We hire the right CEO, and we hold her accountable for risk management within the company. We ask a lot of, constructive types of challenge questions of management. I think in ERM that's especially valuable, where all the assumptions and judgments come in. And then, clearly we have to be very well informed about risk, in order to help the company make the best decisions. So we do a lot, but let me leave it there, since I think I've highlighted the key topics.
Well, Erin, we are wrapping up this interview, and I'm confident our listeners gain significant insight on risk management and what boards need to think through before they make their decisions. Thank you, Erin, for coming on our radio show.
It's been such a pleasure, Sonia. Thank you so much.
Well, this is Sonia Luna, CEO and founder of Aviva Spectrum, signing off.